Jill, is it? And how does that translate into an equity thesis?
Thanks for having me. Well, I think the market views of a dovish Fed pivot, recently, our view at B of A was that, may have been unfounded and that we think that the market could have further to fall. The payrolls report today was obviously very strong. And as the prior guest suggested, suggests that the Fed needs to do more here to tighten financial conditions and to stem inflation. Obviously, very strong wage data. Our economists' view leading into this has been that the Fed would hike 50 basis points and then followed by two more 25 basis point hikes at the subsequent meetings before pausing in 2023 and then ultimately cutting in the second half. I think that, inflation has been very, very strong. And in our view, even though we may not be in a recession yet, the potential for that is still high, and our economists are forecasting that we enter a recession, one that is mild by historical standards. So, the S&P 500, in our view, is not yet reached its bottom. Typically, when you look at other bull markets and the start of those bull markets, typically you see the Fed cutting before the market bottoms. So our view is that the S&P 500 ends the year at 3,600. The sort of worst case floor scenario in the event of a more severe recession, our bottom scenario could be around 3,000 to 3,200, but 3,600 is our base case target for year end.
Jill, why does the equity market in aggregate keep waiting for the Fed, and in particular Jay Powell, to sound more dovish? And why, when we get a tiny hint, maybe that's a mistake or not, we don't know yet, but a tiny hint that maybe that is happening, does the equity market overreact in the way that it has?
Well, I think, one of the things that's going on is obviously the inflation data has been so elevated, and we are looking for inflation to begin to moderate from here. So when you look at the wage numbers this morning, when you look at broader inflationary measures, when you look at mentions of inflation on earnings calls, this has become at a level that it started to hit corporates and hit margins. We still think that consensus expectations for margins and earnings are too high. So we're expecting that S&P 500 earnings next year decline by 8% year over year. Consensus has still been expecting very positive earnings growth, a return to peak margins. So given the wage pressures, we think that seems very optimistic. And I think in terms of the macro data, there's still, the ISM came in better than expected, did deteriorate, but not yet in recessionary territory. Typically some of these macro indicators still may have further to fall. So we expect that there is, going to be a likelihood that we see a very volatile equity market for the remainder of the year, with potential for more downside risk. These bear market rallies, as we've seen, a very strong market the past month in July. These are common. We don't think it was necessarily the start of a new bull market yet.
Okay, Jill, so what in this environment we're talking about, when things are just generally slowing down, why prefer small caps?
So I think, given our view that there's more downside risk and more potential volatility to the market, we still see opportunity within equities at this point. So we think investors want to be focused on particular areas of the U.S. market. So we have still continued to prefer value over growth. We do prefer quality, high quality stocks with stable earnings. We do like dividend yield, which has been one of the strong factors or styles this year. And then we do think that small caps are better positioned than large caps. And usually small caps do underperform in downturns and recessions. But we think that, there are several things going on that I think are supportive fundamentally for small caps. Guidance this earnings season has held up well. Services spending has held up much better than goods spending, and that's where small caps are more exposed to services than goods. The opposite is true for large caps. CapEx has also held up, and small caps tend to benefit more from CapEx cycles in the U.S. So fundamentally, some supportive factors that we're watching, but from a performance perspective, and when you look at multiples and the equity risk premium, small caps have been discounting the recession risk a lot more adequately than large caps have. So we think they've actually been pricing it in more. And so if there's further downside to equities, it could actually be greater risk for large. Yep.
Okay. That clarification at the end, I think, is really important. Jill, when stocks bottom, how quickly will they come back? Investors have got very used to a V-shaped bounce back over the last few recessions that we've seen. Policies come back, it's supported equities, we've all come roaring back. Is that what we're going to see this time round?
Well, I think, at this point, we're closely watching the data. You have seen equity sentiment deteriorate substantially, but when we look at our sell side indicator, which is our measure of Wall Street's average equity sentiment, that still has further to fall before it gives us a buy signal on equities. When we look at, the yield curve and the fact that, earlier this year we saw an inverted yield curve, the flattening of the yield curve typically is a good long leading indicator on what volatility does. So we are expecting that the market is going to remain volatile, not only this year, but potential volatility stays high for the next several years. So, I think we still see more downside risk to the market, but we would really focus on opportunities, as I mentioned within it, overweighting small caps, focusing on stocks that have dividend yield, which is especially important in a low return world.
I'm wondering if one of those downside risks is potential changes to tax policy. We saw a climate initiative out of Capitol Hill overnight with a proposed tax on share buybacks. What impact do you think that will have?
Yeah, we're certainly watching policy, and I think for share buybacks overall, we have been expecting that they're going to be lower than they were trending, for many of the past several years. We are seeing an environment where dividends, we see a greater case for companies to actually raise dividends. Dividend payout ratios are very historically low, and this is a factor that tends to be rewarded in downturns. Companies that can actually pay healthy and stable dividends. Valuations for large cap equities aren't really cheap yet. Obviously, it makes more sense to buy back shares at cheap valuations. And companies are still, overspending on buybacks as a proportion of their operating cash flow relative to history. So, we do see potential that use of cash can still shift, as CapEx has become more important. And there's obviously, even if there's a cyclical downtrend, which can impact CapEx spending decisions, there's still sort of a secular case as companies are reshoring U.S. manufacturing. A lot of companies have underinvested and really need to spend on CapEx. So we're not expecting a net benefit from buybacks to EPS growth that similar to what we would have seen in many of the post-crisis years, pre-crisis, post-global financial crisis years.